Wouldn't it be nice to have a mortgage with an interest rate below 3%? With the recent Fed rate cut, obtaining an interest rate in the twos is possible again, but this will require some negotiating on your part. If you're in the market to buy a home and will use a mortgage for that purchase, I can only assume you want the lowest possible rate and payment. So I'm going to show you the number one tool homebuyers can use to make that a reality. Brand the Mortgage Man here, and today I'm going to provide you with the information necessary to get the lowest possible payment when you buy a home. I've helped more than 10,000 homebuyers over my 20+ year career, putting me in the top 1% of loan originators nationwide, and I always make it a point to educate my clients and show them ways to make homeownership more affordable. In this video, I'm going to teach you how to get the lowest possible interest rate and payment using temporary buydowns. I'll explain what temporary buydowns are, how they work, different types of temporary buydowns, how much they cost, how much they can save, why they only make sense when someone other than yourself is paying for them, and what makes them different than permanent rate buydowns. I'm even going to show you real-life scenarios of temporary rate buydowns in action. So let's get into it. So what are temporary rate buydowns? Well, the word temporary would probably tell you they're not going to stay that way for a long time. They're for a set period of time. And a buydown in general means you're reducing something. So first off, a buydown means you're going to buy your rate down or pay to get your rate down from where it is in today's market to a lower point. A temporary rate buydown means you're setting a period of time for which it's going to be reduced. So 3 years, 2 years, 1 year. So here's what they are. A 3-2-1 buydown, just to try to make it simple. Your rate is 3% lower the first year, 2% lower the second year, 1% lower the third year. A 2-1 buydown. Your rate is 2% lower the first year, 1% lower the second year. A 1-1 buydown. Your rate is 1% lower the first year and 1% lower the second year. And then a 1-0 buydown. Your rate is 1% lower the first year. Now, what happens after the bought down period? Your rate actually increases to whatever your rate should have been. That's why it's temporary. It's not permanently going to be that low. So let's just say you qualified for a 6% and it was 3% the first year, 5% the second year, 4% the third year. It would go up to your set interest rate from year 4 on, right, through 30. Now, you can always refinance, of course, check out my videos on that and how that works. But just so you know, your payment's going to be lower for the first few years in a 3-year buydown, for example, but it's eventually going to go up to what it should have been had you received a 6% from day one. Now, how much do these temporary buydowns cost? Because they're not free. Anytime you're buying something down, there's a cost involved with buying it down. And the cost is based on the loan amount. But the type of buydown is also going to determine what that cost is. So for example, a 3-2-1 buydown is going to be the most expensive. It's going to cost 4.375% of your loan amount. A 2-1 buydown is going to cost 2.25% of your loan amount. A 1-1 buydown is going to cost 1.5% of your loan amount. And a 1-0 buydown is going to cost 0.75% of your loan amount. And these are part of your closing costs on the property. But how much do these buydowns actually save you? Well, the savings on a buydown are going to be substantial, but the savings are equal to the cost. So easy way to figure out what you're saving with a 3-2-1 buydown is multiply the 4.375 by your loan amount. That's how these buydowns work, because the cost is equal to the interest that you're saving over the period of time that the temporary buydown's in place. That's why the cost goes down as the number of years that it's bought down for goes down. So these types of buydowns really only make sense when someone else is paying for them, not you. And the reason I say that is because if you're going to pay, I'm going to make up a number, $10,000 for a temporary rate buydown, well, that temporary rate buydown is saving you $10,000 over the period of time. If you're paying $10,000 to save $10,000, you didn't save anything. It's a wash, right? If I move $1 from my left hand to my right hand, it's still the same dollar, right? I didn't make $1 because it went in my right hand. It was in my left hand to begin with. It was my dollar. So you want to think about it that way. It really only makes sense if either the lender or the realtor or the seller of the property is paying for the buydown. And the most common person to pay for your temporary rate buydown is going to be the seller in the form of a seller concessions or seller credit. Same thing. Check out my video on what those are if you want to learn more about how seller concessions and seller credits work and ways you can utilize them. But it's often used for a temporary rate buydown, right? Because when the seller's paying for it, it makes perfect sense. It's not costing you anything. All it is true savings to you. And a lot of times you may go into an offer on a property thinking it makes sense to reduce the price of the property, but more oftentimes than not, if you're trying to get your payment down, it would make more sense to negotiate to get a credit toward a temporary rate buy down rather than reduce the price of the property. Now, the difference between a temporary rate buy down and a permanent rate buy down, which is known as paying points, other than the name, right? I think permanent pretty much tells you what it is. A temporary rate buy down is for a set period of time. Permanent's for the life of the loan. A permanent rate buy down, though, when you're paying discount points, is going to save you substantially less on the interest rate and on the payment. For the same cost that you're paying for a temporary rate buy down, you may only see a reduction in your interest rate on the permanent buy down of maybe 0.5% to 1%. You're never going to see it go down by 3% or 2%. So you want to keep that in mind. However, a difference between the two when it comes to qualifying for the mortgage is that a permanent rate buy down may help you qualify for a higher purchase price than what you actually qualify for, because the lower interest rate for the life of the loan affects your debt to income ratio. However, on a temporary rate buy down, although your payment is truly going to be lower for that set period of time, we still have to qualify you as a lender off of the true interest rate that you're eligible for. So if it was 6%, we're qualifying you at 6%, not at 3%, which would be the rate in year one on a 3-year buy down. Let's look at some real life examples of how this works, right? Let's just say you have a $500,000 purchase price, you're putting down 5%, and you negotiated a 2-1 buy down. So the seller is giving a credit to buy your rate down for the first 2 years you have the property. So that means you're borrowing $475,000, and let's say the market rate today is 5.99%. So the market rate meaning the rate you qualify for before any buy down comes into effect. With a 2-1 buy down, your interest rate the first year you own the property is 3.99%. It's pretty awesome, giving you a principal and interest payment of $2,267.45. Now, just want to be clear on something. This is only principal and interest. You're still going to have mortgage insurance if you only put 5% down. You're still going to pay property taxes. You're still going to pay homeowners insurance, and you're still going to have an HOA fee if the property is located in a homeowners association community. So, but what I'm comparing now, because the only thing that's affected by the buy down are the principal and interest portion of the payment. So we said the principal and interest year one at 399 is 2267.45. Year two, it goes to 4.99, and the payment is 2549.61. It goes up a little bit. Year 3 through 30, it goes up to the original 5.99%. That was the market rate you qualified for, and your payment goes to 2847.56. The cost of this buy down is $475,000 times 2.25%, as I mentioned earlier, the cost of a 2-1 buy down, which equals $10,687.50. And like I mentioned before, the savings from the buy down equal $10,687.50, right? They're equal to the cost, which is why it doesn't make sense for you to pay for it. But in this scenario, you would have negotiated a credit from the seller of at least $10,687.50 to cover the cost of your temporary buy down, giving you a much more affordable payment for the first couple years of homeownership. Now, let's look at another example. Once again, a $500,000 purchase, you're putting 10% down and you're getting a 3-2-1 buy down. Now, I want to point out something important. When you're getting a conventional mortgage and you want to obtain a 3-2-1 buy down, which I said costs 4.35% of your loan amount, you need to be putting at least 10% down on the property. And here's why. When you get a conventional mortgage and you're putting less than 10% down, the maximum credit you're allowed to get from a seller is 3%. However, when you put 10% down, the maximum credit you can get from a seller increases to 6%. And because we need 4.35% to cover the cost of this temporary 3-2-1 buy down, you need to put at least 10% down in order to get a large enough credit to cover the full cost of that buy down. And most of the time, with most lenders, you can only get a temporary rate buy down if you're getting a credit large enough to cover the full cost. You are unable to cover any portion of that temporary rate buy down. So just keep that in mind. So $500,000 purchase, 10% down. It means your loan amount is $450,000. Once again, let's say the market rate is 5.99%. That means in year one, your interest rate is 2.99%, giving you a principal and interest payment of $1,896.98. Year two, 3.99%, giving you a principal and interest payment of $2,148.11. Year three, 4.99%, $2,415.42. Year 4 through 30 goes up to the 5.99 you initially qualified for, the market rate, $2,697.69. We do the math the same way. We take your buy down cost, right? So it's $450,000 times 4.375% gives us $19,687.50. That's the cost of the buy down. The savings are equal to that exact amount, $19,687.50. Once again, the reason it doesn't make sense for you to pay for it directly, and in this case, you would have had to negotiate or have your realtor negotiate a seller credit of $19,687.50, right? And that saved you a substantial amount of money on your monthly payments in the early years of your mortgage. Now, you can always refinance when you have a temporary. There's nothing stopping you from refinancing, right? And as I mentioned, watch my videos on what a refinance is if you're not familiar, but it's where you pay off your existing mortgage with a new mortgage. The neat thing, or the cool thing, in my opinion, with a temporary rate buy down versus a permanent rate buy down is the cost for this buy down actually still belongs to you. So as you keep the property and keep the mortgage and months go by, it's eating away, in this case, let's say at the $19,687.50, it's starting to eat away at that amount. However, if you refinance after year one and you still have 2 years left on your temporary buy down, there's still money left in that buy down credit that the seller gave you. And that money belongs to you. So it actually would be applied toward your refinance to either pay the balance down or toward your closing costs when that time comes. That's something that does not happen when you have a permanent rate buy down. When you have a permanent rate buy down or pay discount points, which is what a permanent rate buy down is, the moment you close on that property and on that mortgage, that money's gone. So if you sold the property or refinanced 3 months later, you're not getting any of that money back. So it's a pretty neat, cool thing about a temporary rate buy down. The money is still yours. As discussed earlier, since the cost and savings are equal, these buy downs really only make sense when they're paid for by someone other than you, as I mentioned. So the credit you receive from the seller or lender is set aside in an escrow account and it subsidizes your monthly payments. So if you decide to refinance, as I mentioned, prior to the end of the temporary buy down period, you receive a refund of whatever's left in that escrow account, which is pretty awesome. It reduces the cost of your refinance when that time comes. And this is different than the long-term buy down, which is paying points, where those funds are gone, as I mentioned, once you close on the property. So if you find this information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.